Good evening, everyone. How are you? I hope audio and video is okay. Should we start, guys? Oh, let's start. Uh, how many have you? Is this your first class, guys? Can you please confirm how many of you have this first class? So we'll be starting our first class of part two, guys. That's right. So we'll be starting the first part of the part two, guys. First class of the part two. So herein we are going to discuss the income tax. In US, we are having variety of income tax, federal income tax, state income tax, local income tax. In the local income tax, we are also having city income tax, county income tax. Are we going to do everything? In our course, we are having only federal income tax. Besides that, I'll do other taxes also with you. I'll do gift tax with you, state tax with you also. Um, I'll be doing with you self-employment tax also. I'll be doing Medicare tax also. So like this variety of the taxes, we are going to do it inside. In the income tax, we are going to do the federal income tax. Part one. So people who have done the part one, they're aware. Part one is about the individual taxation. That means as an individual, what is going to be your income, expenditure, deduction, all of it will come in part one. Part two is going to be all about business taxation. That means if you're running a business, in US, we are having variety of the corporation, C corporation, S corporation, partnership, tax exempt organization. So how would be the taxability of those guys? And lastly, part three is all about the representation, how you're going to represent your client. So I'll be talking about the part two. Guys, I have to just allow me a minute. I'm restarting my system. Some problem with my scratchpad. Let me just quickly restart my system and I'll join you in a minute. Just allow me a minute. All right, I think that should work now. Yeah. So I was saying that part two is going to be more about the corporation. There are various types of the corporation in US: C corporation, S corporation, pass-through entities, partnership, tax-exempt organization, all of it. There are majorly two types of entities. One is a double tax entity. Second is going to be pass-through entity. What is double tax entity, pass-through entity? In the double tax entity, the name sounds like it. No? How many times the taxes are levied? Taxes are going to be levied twice. One in the hand of the company, second in the hands of a shareholder. Such companies are called the double tax entity. For example, C corporation. C corporation is a double tax entity. Then we are having pass-through entity. Pass-through entity means company will not pay the taxes. Company will not pay the taxes. Rather, the shareholder is going to pay the taxes. Right? For example, S corporation. S corporation does not pay the taxes. Shareholder of S corporation pays the taxes. Similarly, partnership firm does not pay the taxes. Partner pays the taxes in that. These kind of entities, S corporation, partnership, these are known as pass-through entities. Okay. In India, we typically follow previous year, assessment year. In US, we don't follow anything. We typically follow tax year. Now, tax year could be anything. It could be January. Most of the people follow calendar year. Calendar year, when I say that means starting from the 1st of January, ending on 31st of December. Is it possible for you to follow any other period? Yes, possible. If you are having a proper business reason for doing so, you can do that. You can follow any other period also. So I'll be talking about now the various tax years. First, I've already done calendar year. So calendar year would be something which is the period, any period which is ending on 31st of December. Then we are having fiscal year. Don't confuse fiscal year the way we call it in India, financial year. Financial year in India we use interchangeably. हम कभी interchangeably use करते हैं ये fiscal, ये financial now. In US, fiscal does not mean necessarily the financial year. Okay. So fiscal, guys, if I talk about fiscal year is of two types, 50 to 53V, and second is going to be others. When I talk about others, other means any month which is ending month ending other than 31st of December. Other than 31st of December. Month ending other than 31st of December. That period could be anything. That period can be from 1st of July to 30th of June. Any period. That means anything other than the calendar. Copy. I'll talk about 50 to 53 week. I'll talk about 50 to 53 week now. In this, we are having two more categories, guys. Let's see. So this is going to be 50 to 53 week tax year ending same day, not date, same day of last week. For example, it can be last Saturday of November. It can be last Wednesday of June. It could be anything. The screenshot. Let's try one question. Let's say, guys, you are starting. So business started. Business started on 1st of July 2014. Okay. Now, when we are planning, what is the 50 to 53 week we are planning? We are saying it is something which is going to end on last Saturday of November. Last Saturday of November, it is going to end. Take out your mobile phone or if you're watching on your laptop. Should do one thing. Go to year 2014. In 2014, see what is the last Saturday of November. Please go. It is coming 29th of November. Correct? 2014. So it will end here. When the next year is going to start, guys? Correct. Next date. That means 30th of November 2014. Now, when this will end? Same. Go to the last Saturday of 2015. Go check. Go to 2015 and check the last Saturday. 28th of November 20. Correct. When it is going to start next? Next date. 29th of November 20. When this will end? See the last Saturday, November 2016. Correct. 26th of November 2016. I hope it is okay. Let me try one more. Let's say business has started on 1st of July. 1st of July 2018. And we are saying this is going to end on last Wednesday of June. So when this is going to end? June is gone already in 2019, so it will be in 2019. So go to Wednesday in June in 2019. 26th of June 2019. When this will start? Next date. 27th of June 2019. When this will end? Go to last Wednesday in 2020. Twenty-fourth of June 2020. Starting with the next day, that means 25th of June 2020. And this is going to end on last Wednesday. Just here. I hope it is okay. This is one of the categories. Next category in the 50 to 53 week would be same day. Date. I'm not talking about date. Same day nearest to last date. For example, it can be Saturday near to November. Okay. Yes. Let's say, guys, you are starting the business. Business started on 1st of April 2015. And we are saying this is going to end Saturday. Saturday nearest to November end. Saturday nearest to November. So when this will end? 2019 or 2016 or 2015? 2015. Go one thing. Go to November 2015. November 2015. November 2015. See the Saturday near to that. Where are the Saturdays? One is 28th of November, right? What is the second, another Saturday? 5th of December, which is near actually. 28th of November is the near. So we'll end it here. 28th of November, 2015. Simple. Next thing. When this will year start? This is going to start on 29th of November, 2015. Correct? Now, when this is going to be ending? Go to November 2016. Go to November 2016. Right. Where are the Saturdays? One Saturday is in 26th November 2016. Second is 3rd December. Which is closer? 3rd December is closer or 26th November is closer? 3rd December is closer. But we are going in December. Is that okay? Does not matter. Does not matter. What we are looking when your month is ending and the closer date we are looking in that. That's all we are looking at. Okay. So yeah. After that, when will start? Same next date. When this will end? Now, should I look 31st of December? No. I'm still going to look November, guys. That's why in few scenario, it would be crossing 52. In a year, we are having 52 weeks. But since we are crossing sometimes, that's why it's called 52, 53 weeks, guys. So still we are going to look the November. So go to 30th of November, 2017. See what is the closest date? Closest Saturday. Closest, there are two Saturdays. First is 25th of November. Second is 2nd December, which is closest. 2nd December is the closest. I'll take that. Next, we'll start. Continue. We'll continue the same. I hope it is okay. Now, I doubt the question. Obviously, they are not going to ask you such kind of a question in the exam because they are not going to give you any calendar. They are not going to give you any mobile phone also. So, asking this kind of a question is a little difficult. Rather, can give you a question like this. Let's say 30th of September, 2024. 31st of December, 2020. Last Monday of December. 15th June 20, or maybe all of the above. If they ask you which of the following is not a valid, which of the following is not a valid tax year? Which of the following is not a valid year? Why? Correct. This is a valid year. It is a fiscal year. We are looking what is not the valid year. So not the answer. This is a calendar year. Not the answer. Last date is 50 to 53 week. So we're not the answer. 15th of June, guys. This is nothing. This is not valid. That's when the answer. So more majorly questions could be more around like this itself. Okay. Perfect. Now, first time when you are adopting your year, maybe you're adopting calendar year or fiscal year, you don't need the IRS approval. We call it first time adoption. Then you don't need the IRS approval. But whenever you are making any change, right? Whenever you are making any change, maybe you are following calendar year, now you want to move to fiscal year. Whenever you are making the change, guys, you need the IRS approval. Is this clear what I'm saying? Now, another year is called short tax year, guys. What is short tax year? Short tax year means whenever the period is less than 12 months. Whenever the period is less than 12 months. When will it happen that period is less than 12 months? It will happen, guys. In the first year, see, in the first year we have done it. No? You start the business. And when you start the business, initially it is going to be, let's say you are following calendar year only, but you start your business on 1st of October. So first year is this now, short tax year, less than. Second, everyone, it could be when you're switching the year, guys. When you're switching the year, for example, you are following 1st of July to 30th of June. You're following financial year. Now you want to move to the calendar year. So what will happen? 1 year. So 1st of July 2014 to 30th of June 2015. And now you want to move to calendar year. So there would be 1 year, no guys, from here to 31st of December. This is going to be short tax year. 1 year is going to be short tax year. So two scenarios. One, when you start the business, and when you're shutting down the business also, again, that's a short tax year, guys. So three scenarios: when you start the business, when you're shutting down the business. Third, when you're switching the method, that's why we can have a short tax year. Now, in this case, guys, first we are going to calculate the annualized income. What do you mean by that? For example, you start the business on 1st of October. Okay, and you are following calendar year. So you are starting the business on 1st of October. So your business is in 3 months, right? For 3 months, let's say you have earned $3 million. $3 million. Now we will annualize this income, guys. We are going to annualize this. That means this is the income for 3 months. What is going to be the income for the 12 months? Simple. Okay. Step number 1 is annualized income, which is short tax year income multiplied by 12 months divided by short tax year. This is going to be $3 million into 12 months divided by 3 months. Then it is going to be $12 million. Simple. Copy. Second, everyone, step number 2. In the step number 2, we are going to calculate annualized income tax. How do you calculate the annualized income tax? Whatever is the annualized income, we have calculated annualized income in the step number 1, multiplied by tax rate. Whatever is the applicable tax rate, we will multiply. So if, guys, my applicable tax rate is 20% and the income was coming 12 million, this amount is coming 2.4 million. Third is, this is the tax for the annual income, but we need to calculate for the short tax year, guys. So tax on short tax year, which is going to be 2.4 million, is for 12 months. How about for 3 months? Done. Let's quickly try one more question. Let's say period what you are following is 1st of October, 30th of September. And you started. This 1st of July, 2024. Until the end of the year, you made $6 million. Applicable tax rate for you is 20%. Please tell me the tax on the short tax year. $6 million is for how many months? July, August, September, for 3 months. What about for 12 months? The value is going to be $24 million. Then we are going to multiply by 20%. 20% is going to be 4.3. This is for 12 months. How much for 3 months? Going to be 1.2. Okay, I'll move. Now, generally, if you are having a business reason for doing that, you can follow any other period. I'll be talking about the scenario where you must follow the calendar year. So the scenario where you must follow calendar. Let's talk about this. if it is something which is required by law. Law means IRC. IRC is Internal Revenue Code. Internal Revenue Code is just like an income tax act we are having in India, tax act 1961. Same we are having IRC. Second, it is required by law. You have no choice but to follow that, guys. Second is, if you are not maintaining any kind of a books or you're not keeping any kind of a records, then obviously we can't give you that advantage in that. Second, third is everyone when you're not following any accounting period, guys, and you are having no annual accounting. In that case, you have to follow that. Already discussed with you guys. First time when whatever method you are adopting, you don't need the IRS approval. But whenever you're changing the method, you need the IRS. For taking approval, you need to file Form 1128 guys. I'm writing it. Form 1128 is generally filed with IRS to request change tax year. Form 1128 must be filed by return original due date. That is 15th of April, not extended. Generally, IRS allows this because obviously, if you don't have any wrong intention for doing that, so yeah, IRS allows if there is no wrong intention of doing it. Third point is permission to change tax years. Is normally granted when substantial business purpose exists. Sole purpose is to obtain favorable tax status. For example, tax avoidance. That IRS will not allow change. One last note here. Clear. Will be recognized. Only if established as per taxpayers annual accounting period and books are kept accordingly. Way it works in India, you generally keep two books of accounts. One is as per the accounts, and second as per the tax. When I say accounts, account means US GAAP. Tax means IRC. There are going to be some differences between the IRC and the US GAAP. There are going to be some differences. Um, these differences can be of two types. Temporary difference, and second is going to be permanent difference. Temporary difference, permanent difference. Temporary difference is something which is going to reverse in future. Permanent difference is something which is never going to reverse, which is going to be a permanent difference. For example, if let's say you're depreciating any property, you're purchasing any property and purchase property for $1,000 and you are going to depreciate over 5 years SLM, straight line method. Depreciate over 5 years. How much is going to depreciation? This is going to be 200, 200, 200. But maybe as per the tax, this is as per accounts, US GAAP. But maybe as per tax, that means IRC, you are following accelerated depreciation method. That means maybe you're charging depreciation here. 400, 300, 200, 80. So year on year, they are not matching. Year on year, they are not matching. But overall, how much depreciation have you charged? 1,000. How much depreciation you have charged here? 700. 1,000. So eventually you are charging 1,000, eventually you are charging 1,000 as well in that case. So this is temporary difference. That means eventually they are going to agree, they are going to match eventually. Permanent difference is something when they are not going to match. For example, if I talk about, let's say, if you are making the investment into municipal bonds, you're purchasing municipal bond and you are generating the interest out of it. As per IRC, you don't pay the tax on it. Under the US GAAP, you pay the tax. As per US GAAP, it is taxable. It is going to be your income. So this is permanent difference. It's never going to reverse. It's not 1 year or 2 years. It's forever. Whenever the difference is going to be a temporary difference, we create deferred tax assets, we create deferred tax liability. For that, we create schedule M1, M3, etc. It's a very detailed conversation. We don't have it in our course, so I'm not covering it. But generally, the M1 and M3 is quite a complicated forms, and it's very relevant for a practical jobs. Okay. I don't know if you have any questions. We have done accounting year terms. Now let's talk about accounting method. It's possible that you are following cash method, accrual method. Possible. If someone is having different businesses, is that possible? You are following cash method, accrual method, accrual method. That means for different businesses, are you following a different method? Possible. As far as you are having a business reason for doing that, as far as you are having a business reason for doing that, and you're maintaining a separate books of accounts, you can do. Also, it is very much possible that for my business, I'm following accrual method. That means maybe the person is doing a shoe business, running a shoe business, where you're following accrual method. In the evening, you are providing the guitar classes. There you are following cash method. Again, possible. There's no problem in that. 2024, you have done the sale on 26th of December. On 5th of January, you have collected that money. 5th of January, you have collected that money. As per accrual basis, you are going to book the income in 2024. As per the cash basis, you are going to book the income whenever you have collected the money. Cash basis, simple one. Now, for cash basis, guys, we are going to book the income. We have done this in part 1 also, guys. So cash basis will recognize the income based on actual receipt or constructive receipt, whichever is earlier. Whatever it is earlier, that's when we are going to go. Constructive receipt, what do you mean by the constructive receipt? Constructive receipt means that you are having the right to use the money, asset, funds, right to use the money without any kind of a restriction. Without any kind of a restrictions in that case. Let's try and question this. For example, let's say on 1st of December, you have done the sale 2024. And on 23rd of December, you have received the check. Is it correct spelling of check? Yes, that's how we write in US. We don't write like this in US. Okay. That's how we write in US. Check. So on 23rd, you have received the check, guys. This check you have deposited on 2nd of January 2025. You have deposited the check and you got the credit. Credit you got on 8th of January 2025. Now, if I look here, if you are a cash basis taxpayer, this is where I have actually received the money. This is constructive receipt. This is constructive receipt. I have the choice of the check. I have the check. I can deposit in that day also, next day also. I can use that check also. So when you are having the money without any restrictions in that case, that is considered as constructive receipt. So we are going to book whichever is earlier. Earlier is this. So on 23rd of December, you are going to book the income, not when you got the credit. That's irrelevant stuff. I hope it is okay. Any question? Let's say as an EA, you are providing the services to a dentist. And let's say dentist pay you the money. Would that be taxable? Obviously, yes. That is going to be your income. Taxable as the ordinary income. Person does not pay you cash. Person give you any asset. Now would that be taxable? Yes. Whatever is going to be the fair market value, that is going to be your ordinary income. Again, going to be taxable. What is going to be the basis of yours? That means eventually what is going to be the basis of the year? Whatever is the fair market value will become basis, so that in future, whenever I'm going to sell, I know what is going to be my cost in that case. I've done extensively that in the part 1 also. So my basis is going to be fair market value. So let's quickly try one question. So As in EA, you're providing the service, dentist is giving you any asset which the dentist has purchased for $100 in the year 2020. When the dentist has given it, then the fair market value is 120 in the year 2025. What is going to be the income of the EA? Income of the EA is going to be $150 as my ordinary income in the year 2025. Now the basis of the EA will be 150. So that in future, let's say in 2030, this asset is sold by the EA for $500. So from this, I can reduce the basis of 150. So balance $350, the EA will have a capital gains. Simple one. So if the other person has given you cash, again taxable. If the other person has given you asset, taxable. What about the other person provides you a service? That means you have provided the service and dentist is also providing the services to the EA. Would that be taxable? That will also be taxable. Would that be taxable to dentist? Since you are providing the service to dentist, but dentist, this is going to be also taxable in this case. I hope the point is clear. Let me know any doubt. Let's try one question on this. Let's say I'm talking about any mechanic. Mechanic is a cash basis taxpayer. And let's say EA. EA is also a cash basis. Mechanic has done the repair on 1st of December. On 1st of December 2024. EA does not give the cash. In fact, EA has filed the return. EA has filed the return on 15th of April 2020. In which year mechanic will book the income? In which year EA will book the income? Whenever you are going to receive it, since EA is receiving it, EA is receiving it in 2024, then EA is going to book because EA is a cash basis. When mechanic is going to receive it, mechanic is receiving it in 2025. So mechanic is going to book 2020. Is that clear? See, don't consider that other person is giving you, don't consider that the other person is giving you service. Just imagine the other person is also giving you cash. That means imagine that EA, let's look at first look at the mechanic's angle. Mechanic is a cash basis and EA, let's assume, is not filing the return. EA is giving the cash on 15th of April 2025. So when mechanic is going to book the income? Obviously in the year 2025. Because you are a cash basis point clear, Amrita? Same for the EA perspective. Same for the EA perspective. Don't assume that the other person is providing you the service. Assume that the other person is also giving you cash. When that person is giving you a cash, other person is giving you a cash in 2022. That's when it's going to be. So 2024, 2020. Let me know any doubt. Mechanic is doing the repairs in 2020. EA is filing the return in 2021. Both of them are the cash basis. When mechanic is going to book, when EA is going to. Whenever they are going to receive it. Simple form. Let's say mechanic is receiving it. When mechanic is receiving it in the year 2021, mechanic is going to put in the year 2021. When EA is going to put when they are receiving, EA is receiving in 20. I hope it is okay. Same question, but I'm saying that EA is not a cash basis. EA is accrual basis. Will it change for mechanic? Nothing will change to mechanic. Question comes when EA is going to book. If EA is an accrual basis, when EA is going to book. EA is going to book whenever he is providing the service in that case. That means in 2021. This is the difference for the accrual basis. I hope this is okay. Let's try one more question. Mechanic EA. Mechanic is doing the repairs in 2020. EA is filing the return in the year 2021. Both of them is accrual basis. When mechanic is going to book one accrual basis. Mechanic is accrual basis. When you have provided your services, 2020, whenever you have provided your services, that's why you are going to put them. When EA is providing the service, because you are accrual basis, then you are going to. It has no connection with the receipt basis. Okay. Let's say A is providing the services and B is making the payment for that. For whom it is the income, A or B? It is the income for A and obviously expenditure for B. If A is a cash basis, B is a accrual basis. Services provided in 2018, payment done in 2019. When will you book the income? When will you book the expenditure? If the person is a cash basis here, when are you receiving it? You are receiving in 2019, you book in 2019. This person is accrual basis. So whenever the services are received, 2018, please open. Let's say taxpayer. Taxpayer is a cash basis tax. And the taxpayer has promised that I'll pay in 2019. But actually the person has paid in 2020. When will you get the reduction as a cash basis taxpayer? Obviously, you will get the reduction in 2020. It's irrelevant when have you done the promise, all the terminologies. You have done the promise, 100% assurance, 100% guarantee. It's all irrelevant. What matters is when you are actually paying that. Is that okay, everyone? Namrita, you have done classes earlier? No. You have done part one or part two? You have not done part one or part two? This is your first class. But you joined very late. You should join from the previous year. Anyways, I think see that from the beginning, you'll understand better what we are doing. Okay. Now, cash basis method, cash basis method is generally followed by the individuals. It is generally followed by the small companies. Individual, small companies. Generally, cash basis method, generally the cash basis method is not available for C corporations. It is not available when your inventory requirement is very high. That means in the business where you keep a high amount of inventory, you don't follow the cash method there also, guys. In case of a partnership where a company is a partner, again, you don't follow the cash method. Or any of the tax shelters, guys, any of the tax shelters, again, you don't follow the cash method. What is tax shelters? Tax shelters is any structure. Tax shelter is any structure which you have created for the purpose of avoiding the tax. For example, if let's say I'm associating with VGLD and let's say VGLD pay me the fees. Let's say if they pay me $1,000 and if I'm sitting in the 30% tax bracket, I will pay $300 tax. Instead, what I do it, I'll try to create a company. Maybe I'll create a company, AR company. So instead of taking the fees in my personal name, I'll take them in my company's name. Income I'll show here $1,000. But then I'll show the salary to my mother, to my father, to my sister, right? So 400, 300, 300. So that nothing profit is left. And obviously on this, they are going to pay the tax, but maybe they are in the lower range of tax. Maybe 40% here, 40 here, 30 here, maybe 30 here. So overall, how much tax is gone? $100. But in this arrangement, $3,300 is gone. But why have you created this structure? You have created this structure to avoid the tax in this case. This kind of a structure is known as tax shelter. Tax shelter. Could be any other structure. I'm just telling you one of the structure. Now, I'll be talking about few exceptions now. Exceptions means that even these corporations are the company. These companies can follow the cash method. I'm talking about the scenario where you can follow the cash method. First is going to be PHC. PHC is a company, is a corporation. PHC is Personal Service Corporation. Personal Service Corporation. That means a company you have created, which is more about professionals, guys. For example, if you guys become the EA and you create a company, that company would be PHC, Personal Service Company. So any company which is in the field of accounting, actuarial, engineering, anything. I'm not writing it full because you'll find it in your book also. So in this case, generally those corporations are considered as PHC. If you are PHC, you can follow cash method in that case. Second, if you are farming, if you are running a farming business, guys, then again you can follow the cash method. If you are following the farming business, again you can follow the cash business. Third category is going to be specified corporations. Specified corporation. Specified corporation or a company. What does that mean? Any company or the partnership firm where your AAGR is more than $30 million. What is AAGR? AAGR is annual average annual gross receipt. Average annual gross receipt. This, if your AAGR is more than $30 million, that means you are a big organization. If you are a big organization, then ideally you should not follow the cash method. You should follow accrual method. But if you are not crossing it, guys, that means you are up to $30 million, guys, then you are a small organization. Since you are a small organization, you can follow the cash. I hope it is okay. This is known as GRT. GRT is gross receipt test. Gross receipt test. Let's try one question. So what we are saying is the AAGR. That means we are going to do the average of last 3 years. So that means if my current year is 2024 and I want to know whether I can follow the cash method here, I'll go back to the 3 years, guys. That means 23, 22, 21. In this case, we'll find out what is your annual gross receipt. Annual gross receipt, annual gross receipt. Let's say this is coming 33, 39, and 30. Then we are going to do the average of. What is the average of it? 34, approximately 34. Since it is average is coming 34, that means you have crossed 30 million. Can you follow the cash method? I hope it is okay. Because then you are a big organization, you cannot follow the cash method. $10 million, 20 million, 30 million. Can you follow the cash method? What is the average coming? 30, 30, 30, 60, 20. Average is coming 20, which is less than 20. We are not crossing 30. So in this case, you can follow cash method. Is that okay, Amrita, here? We have discussed short tax year. Short tax year. What is short tax year? That means maybe you are starting the business late, right? And you don't have full 12 months, right? So maybe 1 year it is 20 million, another is 15 million. But in 3 months, maybe you are starting the business here. On 1st of October, you're starting the business here, 2021. So that means business is there for how many months? Business is there for 3 months. And in the 3 months, you have earned $3 million. So should we take 3 million, 20 plus 15 and do the average of it? We are going to annualize this. So 3 million is for 3 months. Then for 12 months, what is going to be? For 12 months, it is going to be $12 million. Now we are going to do the average of it. 12, 20, 15. We are going to do the average of it. And then if it is, let's make quickly 35, 35, 12. 35, 12 is 47, 47 divided by 3, so almost 16. 16, that means less than that, so you can follow. Simple problem. Let's try one. Let's say few EAs, guys. Few EAs has started the PS, and their, if I'm talking about their AGR is 30 million, 36 million, 39 million. Can you follow the cash method, your cash basis here? Can you follow cash method? Yes. Can you follow cash method now? No, you're crossing. Are you not crossing 30 million follow? So it's 36 plus 30 plus 39. So 35. No? The average is coming 35. Can you follow cash method here? You are crossing 30 million. Will you follow cash method here? Yes. Reason being, for PHC, we are not looking the values, guys, if you remember. For PHC, we are not looking. This is only for the qualified organization. For PHC, we are not looking the gross receipt test, everyone. So PHC can follow the cash method here. Irrelevant. Just irrelevant. I hope it is okay. Now, this limit is $30 million. This is indexed for inflation. Indexed for inflation. What is the meaning of index for inflation? What is the meaning of index for inflation? Index for inflation means this is going to change year on year. Before that, it was 29 million, 28 million, 27 million. Because of the inflation, they keep on increasing. In 2018, Trump has passed a very substantial law, which is called TCJA. In 2018, he has passed a very substantial law for the TCJ, Tax Cuts and Jobs Act. Tax Cuts and Jobs, we also known as Jobs Act. Pre-TCJ, the limit used to be $5 million. So Trump has increased this limit substantially. Now this limit is $30 million. Right. When the limit is $5 million, is it good for the taxpayer, bad for the taxpayer? Or should I say a different way? Now from $5 million, it has increased to $30 million. Good for the taxpayer. This increase is good for the taxpayer, bad for the taxpayer. This increase is obviously good for the taxpayer. That it's, I can follow that previously if someone is earning $10 million, AAGR is coming $10 million, that person cannot follow cash method. But now if someone is having $10 million, that person can follow cash method. Obviously, it is good for the taxpayer. If someone's AAGR is coming $10 million, can this person follow cash method? Yes, you can follow cash method. Is it mandatory for you to follow the cash method? No. It's your choice, no, guys. It's a choice they have given you, guys. Rest is your choice. If you don't want to follow cash method, that's absolutely okay. There is no problem with that. I hope the point is clear. Now, there are various long-term contracts. Various long-term contracts. Long-term contract means you have started in 1 year, maybe anything you have started in 2024, but it can't be finished in that year. Maybe it is finishing in 2025, 2026. So any project which you are starting in that year and you're not finishing in that year is called long-term contract. Generally, construction contracts are known as long-term contracts. Here we are having two methods. Here we are having two methods of booking the income. Similar thing we are having in AS7 also in India, guys. Accounting Standard 7. What are the two methods we are having? We are having CCM. CCM is computed cost method. CCM. Second is going to be PCM. PCM is not physics, chemistry, maths. PCM is percentage of completion method. Percentage of completion method. Let's say if the project cost is approximately $600 and project revenue is approximately $1,000. So how much is going to be my project profit? Project profit is going to be $400. Let's say project is for 3 years, guys. Project is for 3 years. First year, second year, third year. In this case, guys, completed cost method, guys. In this case, we are not going to book anything in the first 3 years. We are going to book this at the end of the period, guys. When the project is finished, that's where all of it, entire 600, 1,000, everything we are going to book at the end of the period. Is my point clear, guys? But under the percentage completion method, as and when the work is getting finished, maybe 30% work is done, you are going to book 30% here, maybe 120. Maybe 50% work is finished, then we are going to book $200. Then maybe 20% work is finished, then we are going to. So as work is getting finished, we are booking the income. I hope it is okay. General rule is for the long term, we are going to follow PCM, percentage completion method. Then obviously I'll talk about exception. Exception means though even the contract is for long term, that still we can follow. We don't need to follow PCM. That means I can follow CCM. Simple one. I can follow CCM. Again, it's a choice given to you that you can follow CCM. Is it compulsion that boss you have to follow CCM now? Again, it's a choice given to you. Up to you. Don't want to follow CCM, you can follow PCM. It's a choice which is extended to you. There are two scenarios, guys. There are two scenarios where you can follow CCM. Let's understand what are the two scenarios. Two scenarios where you can follow is HCC and SCC. HCC is home construction contract. SCC is small construction contract. HCC and SCC. In these two scenarios, I can follow CCM, guys. CC. Let's understand what is this. First, let's see HCC. HCC is the home construction contract. So basically what happens, guys, you are giving your space, maybe you are giving your space and land to a contract. And you have given your specification to the contractor that boss, I want this and this. I want a terrace. I want a terrace garden. I want a balcony after every room. I want a garden also, whatever. You have given your specification, right? And as per your customization, the contractor is making the house for you. That is known as HCC. So in this case, you can follow CCM. Who's going to follow? Obviously, contractor. It is the income for the contractor, no? So contractor is going to book the income on CCM basis. I hope it is okay. So generally, if you are making the house, it will not take too many years, no, guys. 2 years, 1 year, 2 years, 3 years. Max to max, you are going to finish that. It's not like Antilla, which will take many, many years in that. Right? So generally, in 1 or 2 years, it is going to finish. So we are allowing you the CCM method in that. Second is SCC, small construction contract, guys. How to decide if something is small or big? Same funda what we have done it, guys. Small would be decided by your gross receipt test. Small would be decided by the gross receipt test. That means if your AAGR is less than equals to $30 million, then we are going to assume you are small. Plus, there's one more condition that the project you are starting, you are finishing that project within the span of 2 years. If you are satisfying both the condition, that means the AAGR is less than equals to $30 million plus any project you are taking is finishing 2 years every month. In that case, we can assume you as SCC, small construction contract. And in that case, you can follow CCM. I hope it is okay. If AAGR of the person is $20 million, person is not HCC, let's say, and the project you are finishing in 3 years, can this person follow CCM? This person follows CCM. No, because you're supposed to finish within 2 years. Okay. If the AAGR is 40 million, but you're finishing the project in 2 years, can you follow CCM? Again, no, because you are crossing this. Okay. I hope it is okay. Namrata, what have you done? Have you done any US tax or something? What have you done? Education wise, what have you done? Where are you working? But what have you done otherwise, education wise? MBA you have done. And what have you done in the field of US taxation? Where have you worked? State tax. Where? Okay. State taxation, not the federal taxation, federal income tax. Sure. So let me know anything is not clear. I'll do one question for the PCM, though it's very simple, but I'll quickly do one question for the practice itself. Um, if I say, let's say project cost is $1,500 and revenue is $2,000. The profit is 500. If let's say year 1, 2, 3, if the cost incurred, which would be given in the question, is let's say 500, 200, 800. So total cost is 1,500, the way we have discussed here. So we'll calculate how much percentage of the work is done. So simple, 500 divided by 1,500. So almost 33% work is done here. 200 divided by 1,500. That means almost 13% work is done here. and 800 divided by 1500. 54% work is done here. Now I allocate on that basis, guys, the revenue in every other item. That's good. So revenue is 2000. I'll allocate on that. This multiplied by this. So 2000 multiplied by 660. 660. This is going to be 260. And 2000 multiplied by 54% is approximately 1080. The total is 2000. Cost we have already know. This is the cost 500, 100, 800, that is 50. Total is coming 160, 60, 280. If you the total, it's the same for 5. Okay, we can stop here for a break. And I'll see you guys after the break, 8:20. Thank you. Stop. I will start. Um, let's say in the year 2020, someone has purchased the item for $10,000 and you are incurring the manufacturing expenditure of $1,000. But you could not sell anything in this year. Maybe COVID arrived, lockdown happened. Anyone cannot sell anything in this year. In this year, if I ask you, how much is your gain or loss? How much is your gain or loss? There's no gain or loss. Everything will go into closing stock, right? And next year it will become opening stock. Simple one. Next year it will become opening stock. So basically, guys, when we do This method is known as absorption method. What is absorption method? Basically, sales. From this, if I'm reducing COGS is cost of goods sold. COGS is cost of goods sold. That means, in a way, the manufacturing cost price. If I'm reducing sales from COGS, what do we get? We get gross profit. Now, from this, if I'm going to reduce SG&A, selling, general, and administration expenses, we arrive at operating profits. I hope it is okay. Now, this method is known as absorption method. Absorption. I'll talk 5 minutes about the COGS, cost of goods sold. COGS, cost of goods sold. How do you calculate COGS? COGS is basically opening stock plus purchase. If you are incurring any kind of a medical expenditure, not medical expenditure, manufacturing expenses minus closing stock, plus minus any kind of a return, minus any kind of a discount you're getting, all of it less. That will give you COGS. Another way of calculating COGS would be sales minus gross profit. Now, this is one of the approaches, guys. This is one of the approaches in that case. If I do differently, guys, that means if I'm saying sales, from sales, if I'm reducing variable cost, what do we get? We get contribution margin. Sales minus variable cost, we get one. From this, if I'm going to reduce fixed cost, we are again going to get operating profits. Operating profits. This method is known as direct method. Direct method, variable method. Point is, for US GAAP, we follow absorption method. For IRC, for tax purposes, we are following the absorption method. That means for external reporting, we follow absorption method. Direct method, variable method, we follow only for our internal purposes, not for external purposes. US GAAP, IRC says follow absorption method. That's why I just want to cover this, guys. Okay. I'm just writing a note on this. COGS, cost of goods sold, includes cost of goods sold include both direct cost, direct, indirect cost. And both variable cost and fixed cost. As far as they are related with, as far as they are related with, as far as they are related with manufacturing or finalizing the account. IRC and US GAAP. IRC and US GAAP requires follow full absorption costing method. Not variable. If someone who's a manufacturer versus someone who's a retailer, manufacturer is having three types of inventory: raw material, WIP, finished goods. But someone who's a retailer, someone who's a trader, will have only one kind of inventory, which is basically finished goods. That person will not have raw material, WIP, and taxes. That's why it is also called retailer's inventory. That is also called the manufacturer's inventory, guys. Now, there are two things, guys. One is the trade discount. Trade discount. Second is going to be cash discount. What is the difference between the trade discount and the cash discount? Trade discount is whenever you are purchasing anything in the bulk. We also call it trade discount. We also call it bulk discount. We also call it quantity discount. So whenever you are purchasing anything in bulk, let's say if you go anywhere and you say that I'm going to bulk purchase few cells, right? I'm going to purchase 100 cells in one go. Then the person will give you discount. That discount is a trade discount. Simple. Then we are having cash discount. If you make the payment, maybe the person is giving you time to pay for 30 days, right? But if you pay that money within 2 days, then if you pay the money early, this is where you are going to get the cash discount. I hope it is okay. Now, various method of accountings are there, guys. I'll cover the various inventory method in brief because obviously those are not so much relevant for your exam purposes. First method of inventory is going to be SIM. SIM is not mobile SIM. SIM is specific identification. Specific identification method. Specific identification method means I know exactly how much each inventory is for. I know this is for $20, this is for $60, this is for $80, and so on. Specific identification method we generally follow whenever you are having any kind of a customized product, whenever the product is expensive, guys. For example, jewelry. In jewelry, you would be aware about how much each ring is for. You will not do the averaging of the ring. No, you will not exactly how much necklace, ring, bracelet is for. So that's where we follow the SIM, specific identification method. Next we have is the FIFO, LIFO. I don't think I need to teach you. You are so much aware about the FIFO, LIFO. First in, first out. Last in, first out. That means whatever you are purchasing, guys, and when you are selling, first this will go, then this will go, then this will go. But under the LIFO, guys, if you are selling, then the last item will go, then this will go. That is LIFO, guys. LIFO and LIFO, guys. Simple. I'll try one question afterward. On the top, I'm writing dates. So it's 1st of January. I'm writing units here. And below, I'm writing dollar per unit. So units are 10 units. On 1st of January, you purchase 10 units and you're purchasing $10 per unit. Then you're purchasing on 1st of April. 1st of April, you are purchasing 40 units, and 40 units you are purchasing for $40 per unit. 1st of June, you are purchasing 80 units, and 80 units you are purchasing for $80 per unit. Then you are purchasing 1st of October, 30 units you are purchasing for $80 per unit. So how much you have purchased? 10 plus 40, 50, 130, 160. So total you purchase 160. And let's say you have sold 100. So basically the closing stock is going to be 60. Okay. Now I'm going to do it via FIFO, guys. How to do it via FIFO, guys. What is going to be my COGS? COGS and the closing stock. FIFO. I'm selling 100 units, guys. 100 units. So I should sell FIFO, first in, first out. So first I'll sell this, then this, then this, then this. Right? So 100 I'm selling. So 10 will go to COGS. Anything is left in the closing stock? Nothing. Always look in the isolation, guys, else you get confused. So nothing closing stock in this. Out of 100, 10 is gone from 1st of January. Then 90 is left. Then 40 will be from here. Nothing is left here. Out of 100, 50 is gone. How much is that? 50 will be here. 30 is the closing stock. Out of 30, nothing is left. 0. And 30 is closing stock. Once you have this, guys, it's very easy. I just need to plug in the numbers. I just need to multiply by the dollar value. That's all, guys. Easy. So what is going to be COGS for me? 10 into 10, 100, 100, 1600, 1600, and 4000, 5600. No? 100, 1600, 1700, 1700, and this. So COGS, cost of goods sold, is going to be 5700. What is closing stock? 18 to 2400, 2400. It is going to be closing stock is going to be 4800. Simple. So I'm writing here. COGS, closing stock, and total. P4. T700, 40, 800. This is going to be 10,500. Same question. Let's do with the LIFO. LIFO. Which one I'll take first? I'll take 1st of October, guys. So COGS, closing stock. So first I'll take here 30 here, nothing here. 30 is gone, so 70 is gone. So 70 is going to be from here, 10 will be here. Then 0, then 40, then 0. Simply multiply by the rate, guys. So now COGS is how much? This into 5600, 5600, and this 2400, it is 8000. So COGS is going to be 8000. Then everyone, 100, 1600, and 800. So 100, 1600, sorry, 1600, 100, 1700, 1700, and 800, 2400. Closing stock. See, it's just a quick checkpoint, guys. Value will change, guys, if you see here, right? And it is 2500. Total will always match. It's a good cross checkpoint for you. Total is always going to match. I'll try one more. Weighted average. Weighted average is simple. I'll multiply everything. This is going to be 100. This is going to be 1600. This is going to be 6400. This is going to be 2. So if I do the total of that, 10,500. And how many units you purchase? 160 units. What is this going to be? Yes, 6. Per unit. Per unit, it is coming 65625. So how much you are selling? You are selling cost of goods sold. How many units I'm selling? I'm selling 100 units. So 100 units at the rate 65.625. So this is going to be 65, round of figure 6563. How much is the closing stock? Closing stock is going to be 60 at the 65.625. Total is 10,500. 39. Weighted average is 6563 at 39. Total should match. Always match. Just a cross check point for you so that you're not committing any mistake. I hope it is okay. 10 units you're purchasing for 10, 20 units. I'm purchasing for 20. 30 units I'm purchasing for $30 per. 40 units I'm purchasing for 40. So how much you're purchasing? 30, 60, 100. So you're purchasing 100. Let's say you are selling 17. So what is going to be the closing stock? Closing stock is going to be COGS, closing stock, over P4, P4, weighted average. So what is going to be the answer? That means you need to plug in the 6 values here. What is going to be the answer as per FIFO? What is going to be the answer as per the LIFO? What is going to be the answer as per weighted average? Try everyone. See. First, I'll do it with the FIFO. FIFO, first in, first out. So we are selling 70. So COGS and closing stock. 70, first 10 here, 0 here. 20 here, 0 here. 30 here. So 30, 0 here. 10 here, 0. I can do it, Namrata, but you have to join it timely. I mean, if you join very late, you will not understand anything. You have to be involved in the class. Right now, I'm just doing it for the recording actually. If you do class regularly, then you will understand this. Do you understand FIFO, LIFO? Do you understand FIFO, LIFO? That's what I'm saying. If you don't tell me when I'm interacting with you, if you don't ask me, then how will I do? Right? It's a two-way communication. Okay? So if you don't involve, then I can't help it. No? You have to tell me that this is not clear. What is that? I'll help you out with that. I've done the full-fledged question, but you were keeping quiet. You were not telling me anything. How will I know? You have not done in your MBA also, you have not done LIFO, FIFO accounting. No? So, generally, we don't allow that. But anything you want to say? Wait. Regularly, you will ask your queries via chat only. Let me see if I can. Do you have any question, Namrita? Do you have any question, Namrita? What is the importance of FIFO, LIFO? In the taxation, I just want to tell you that where my COGS is going to be higher. I just want to do a couple of questions with you and show you where my COGS is going to be higher. If I tell you where my COGS is higher, it will tell you how my taxable impact is getting impacted. Let's do it in a simple way. Do you understand FIFO, LIFO or not? You don't understand FIFO, LIFO. Then why only worried about the taxation when you don't know the FIFO, LIFO? FIFO, LIFO is the inventory method. Okay. For example, you are purchasing one item for $10. You are purchasing any item for $15. You are purchasing another item for $30. Another item for 35. Another item for 45. Okay. You purchase how many items you purchased? 5 items. Let's say you have sold 2 items. That means what is your closing stock? How many units are left in the closing stock? 3 items. You have sold 2 items, so that means your COGS, cost of goods sold, 2 items you have sold is 2. Is that okay? A FIFO, LIFO tells you that which item you are selling. Let's say you're purchasing this in January, February, March, April, May. So when you are saying first in, first out, which one you will sell first? January item, February item, March, April, May. Which one will you sell first? You are selling 2 items. No? You are selling 2 items. Why will you sell 3 items? You are selling only 2 items. No? Correct. So you will sell this for 10, something which you purchase for this. Is that okay? What I'm saying? So this is my COGS. That means the items you have sold, what is the cost of that? This is the cost of goods sold. How much is the cost? Cost is $25. Is that okay? So this is gone. This is gone. How much is left? What is the value of the item which is left, which is your closing stock? 110. Correct. Are we good? Point clear? This is okay. This is as per FIFO. Are we good up till here? Same thing if we want to do with the LIFO. Same thing we want to do with the LIFO. Then which is the first item will you sell? January, February, March, April, May. Tell me exactly. Which one will you sell first? First 45, then 35. First 45, then 35. Yeah. So what is my cost of goods sold? The items which I've sold, what is the cost of that? $80. Is that okay? So this is gone. This is gone. What is my closing stock? $55. Now, if you see the prices here, if you see here the prices, I purchased for $10, $15, $30, $35, $45. Is the prices going up or down? Is it inflation or deflation? It's an inflation or deflation? It's a inflation. It's a inflation. Whenever there is an inflation, I'm putting this value. So I'm merging both of them. This is as per FIFO. As per LIFO, what is your COGS was coming from? 80 and 55. Is that okay? Forget everything else. Forget everything else. Just look at the table. Just look what we have made here. In this, where my COGS is higher, FIFO, LIFO. COGS, where my COGS is higher. FIFO, LIFO. Is my point clear? LIFO. Where my closing stock is higher. Is it okay? Clear? Point clear? Yes, no? So whenever I'm talking about FIFO, COGS, closing stock. FIFO, COGS, closing stock. Whenever there is a period of inflation, COGS is higher here and closing stock is higher here. Are we going to point here? Yes, no? Whenever the cost, COGS is what? COGS is nothing but my cost. So where my COGS is higher, FIFO, LIFO? COGS is higher under the LIFO. You have just done this point here. So whenever my cost is higher, your profit will increase or decrease? Profit will increase or decrease? Profit will decrease. When the profit will decrease, taxes will increase or decrease? Tax will increase. That is why people can use the LIFO for manipulating the taxes. Point clear what I'm saying? That is why whenever you are moving, whenever you are changing your accounting method, right? Maybe earlier you were following FIFO and now you are moving to weighted average. Then you do not need the IRS approval. Do you understand what is IRS? IRS is the tax authority of federal income tax in US. So if you move from FIFO to weighted average, you don't need the IRS approval. But if you move from any method to the LIFO, then you need the IRS approval. Is my point clear? Why? Because people may be moving to the LIFO to manipulate the taxes, guys. That's why IRS wants to look into it very carefully. Is my point clear? Yes, no. No, should I repeat this? Allow it. IRS allows it. Do you understand what is IFRS? Do you understand what is IFRS? IFRS is not US GAAP. My question is, do you understand what is IFRS? So US GAAP is the accounting method which is applicable on the US companies. So US companies follow US GAAP. But other than the US, Australia, Europe, they follow IFRS. Is that okay? Other than US, non-US companies follow this. In this case, IFRS does not allow LIFO method because of the same reason, because LIFO is manipulative, IFRS does not allow. Yeah, these are accounting rules. But LIFO is allowed by the US GAAP also, US GAAP also, that means accounting also, and IRS, IRC also, they also allow you. They also allow you, but if you are changing it, then you need the approval from them. That's all. And if they find that it's a genuine case, they will still allow. I hope my point is clear. What I'm saying. No, should I repeat anything? There are many differences I've discussed, started with this only. There are many differences. I told you temporary difference, permanent difference. Have you heard that conversation? So there are many differences. Interest on muni bond, depreciation tax rate, depreciation method, many differences. In fact, let's extend that also. US GAAP. US GAAP is not the part of IRS. No? In India also, do you understand Indian laws? In India, which tax authority follows which laws? Tax authorities, CBDT follow which laws? Follow income tax. India, UK laws will follow currently. India, why will they follow UK laws? India, ACC India कहाँ से आ गया? In India, I'm saying. ACC is not India. In India, if you are following Income Tax Act 1961, for accounts, guys, we follow IND AS and Companies Act. They are not same. There is going to be a difference in both of them. They are different. Same in US also. For accounts, we follow US GAAP. For accounts, we follow US GAAP. For tax, we follow IRC, Internal Revenue Code. They are not same. There are going to be a lot of differences in that. Is it clear? Please ask whatever the queries, because I don't know what you understand, what you don't understand. So keep asking your queries, whatever is coming to your head. Okay? US GAAP and IRC will have some differences. It is possible, for example, if I'm talking about depreciation. In US GAAP, you follow SLM. In IRC, you follow accelerated depreciation method. It is possible. Is it possible that I am following FIFO method of accounting here and weighted average here? Possible. But if you are following LIFO here, you have to follow LIFO here. Same way, if you want to follow here LIFO, you have to follow here. That means LIFO, whenever you are following under the US GAAP and the IRC, it has to be same. Is that okay? नहीं, जब दोनों सेम ही नहीं है नम्रता, फिर गवर्निंग बॉडी सेम कैसे हो जाएगी? गवर्निंग बॉडी है नहीं इसकी पीकोब है, इसकी IRS अलग अलग governing body is not for preparing tax return through form. No, you don't need for preparing this. You need IRS only. You don't need to worry about this. Clear, नमिता? बहुत ज्यादा नॉलेज आपको यूएस गैप की जरूरत नहीं पड़ेगी. Should I move any other question? So since you were asking what is the advantage, since you were asking the advantage that why are we looking the FIFO, LIFO under the tax, that's the reason. Because LIFO has higher COGS. Since they are having the higher COGS, their profits are going to be lower and the taxes are going to be lower. Right? So it can be manipulated. Generally, in this case, IRS wants to keep the control and they want to take, if you are following it after any change, IRS needs to give the permission. Point here, Namita? हर जगह नहीं अप्लाई होता ना, हर जगह अप्लाई नहीं होता. Business is like that only. For example, Namrata, let's say you are running Amul, right? Amul, you understand Amul Dairy? Amul Dairy में LIFO कैसे अप्लाई करोगे आप? आपने आज मिल्क खरीदा 27, 28, 29, 30th, तो आप पहले 30th वाला माल बेचोगे. That's why I'm saying not every business can follow LIFO, na? Not every business can follow LIFO. You have to see your line of business also. Just for making the benefit, I can't do it. Is it clear what I'm saying? Any other question? Generally, whatever the inventory we are having in stock, whatever the inventory we are having, we value them on cost or market price, whichever is high or low, whichever is lower. We value them whichever is lower. Let's try one question. Let's say we are having various product A, B, C, D. Cost of this product is $10, $15, $40, $100. Alex, 165. Then if I take the market price is $5, 25, 55, 95. Which one should we take? Value, give me value. Like what value should we value that? My question is, these are the various products, product A, product B, product C, product D. I have given the cost of all the products. I have given you the market price of all the products. I'm saying what should be my final inventory value, total inventory value. 180 because you are picking the higher value. You will pick higher value. I'm saying in your books of accounts, just discuss now. In your books of accounts, you will show at lower value now. That's what I'm asking. At what value will you show? Give me a value now. That's what I'm saying. No. We are not going to look on a total basis. We are going to go item by item. That means 5 here. That means 15 here. That means 40 here. 9. Is my point clear? Not on a total basis. Clear? Each item in inventory, each item in inventory shall be valued separately, not in agreement. While we make accounting values. Accounting entries की बात नहीं है ना हमारी सिर्फ. We are not concerned about the accounting entries as such. We are saying accounting entry नहीं कर रहे हैं हम. पहली बात हम टैक्स देख रहे हैं ना. अकाउंटिंग एंट्री तो यूएस गैप में कर रहे हो आप. वी आर नॉट लुकिंग यूएस गैप में. आर पॉइंट इज जब भी आप वैल्यूएशन कर रहे हो अपने टैक्स पर्पस के लिए, देन वी आर गोइंग टू टेक द लोअर वैल्यूज आइटम बाय आइटम. दैट्स ऑल. अकाउंटिंग एंट्री तो जो हो गई आपकी कॉस्ट पे किसी भी आइटम. वी आर नॉट डूइंग अकाउंटिंग एंट्री. इज माय पॉइंट क्लियर? On 31st of December 2024, let's say your inventory is 200 units. On 1st of January 2025, what should be my inventory? Has to be same. Why can be a different in that case? Should be same. But is it possible that they are not same in some scenarios? Maybe in the night, someone has stolen that, right? Someone has stolen that, right? Maybe there is any kind of a pilferage in that. So any kind of a normal or abnormal, whenever it is happening, in this case, you have to tell the reason why is it happening. Is my point clear? You have to explain in your return why is it happening, why your 31st inventory and first inventory is not matching. You have to report that reason. Point clear? If you are having the inventory of 100 units, and let's say out of that 20 units you have given in charity, 20 units you have given in charity. So should you reduce that? Should you reduce that in the closing stock? Twenty units you are going to reduce in your closing stock. Will you get the reduction for that as a charitable deduction? As a charitable deduction, will you get the reduction for it? Yes, you will get the reduction for the charity. Taxpayer has sent the material to a consignment agent. You have sent the material to a consignment agent. When you send the material, when you send your inventory to the consignment agent, do you book the sale? You don't book the sale when you sell to your consignment agent. It is still your inventory. The person is just acting as an agent only. This is the inventory of the person only. Is my point clear? So that means maybe you have sent the material on 10th of December 2024. At the year end, that means 31st of December 2024, the person has not sold the material. Agent has not sold the material. Whose inventory is that? Taxpayer or consignment agent? It would be taxpayer's inventory. Is my point clear? In the shipping, we are having two terminologies called FOB. FOB is free on board. Here we are having two things: free on board on destination, free on board at shipping point. Free on board on destination and shipping. What do you mean by that? That means if let's say you're sending it from India. If it is FOB shipping, that means the moment you load the material on the ship, after that, it is not the responsibility of the seller. In between anything happens, whose responsibility is that? Is it the seller's responsibility? No. Then it is going to be buyer's responsibility. Shipping agent would be working for the buyer in that case. So it would be the buyer's responsibility. Point clear what I'm saying? But it is not going to be seller's inventory. Point clear what I'm saying? So in transit, whose inventory is that? Buyer's or seller? Whose inventory is that in transit? In transit, it is going to be buyer's inventory. Buyer's inventory. Seller तो चढ़ा के छोड़ दिया ना seller ने. FOB shipping means आपने load करके free हो गया. You don't care what happens in between. Then it is not the this is the seller, this is the buyer here. I'm not talking about consignment agent. I'm talking about normal buyer and seller now. Okay. So the moment you load the material, after that it is not your inventory. No? It is the buyer's inventory. Is that clear? But if it is FOB destination, then it is your responsibility to make sure that this reaches here to the destination of the person. So anything happen in transit, who would be responsible for that? Seller or buyer? Seller is FOB destination. FOB destination. So it is the seller's duty to make sure it reaches here. So in this case, it is the seller's duty. Is that okay? In transit, whose inventory is that? Seller or buyer? In transit, it is the seller's inventory. Is this clear? Should I repeat this? Should I repeat? Is it clear? Look at it. This is FOB shipping. That means यहाँ लोड किया, आपने गुजरात के पोर्ट पे लोड कर दिया. गुजरात पे लोड करने के बाद आप फ्री हो, आपकी कोई रिस्पॉन्सिबिलिटी नहीं है. इज दिस क्लियर? सेकेंड पॉइंट, FOB डेस्टिनेशन. दैट मीन्स आप गुजरात के पोर्ट पे लोड करके फ्री नहीं हो. यू हैव टू मेक श्योर दैट ये पेरिस पहुंचे. FOB डेस्टिनेशन. डिफरेंस क्लियर है दोनों में? तो FOB शिपिंग, अगर FOB शिपिंग है, in transit, are you responsible? If you are a seller from India, are you responsible for in transit? If you are FOB seller, FOB shipping, sorry, FOB shipping. If you are FOB shipping, are you responsible for in transit? नहीं है ना, वही तो मैं आपको समझा रहा हूँ, आप सुन ही नहीं रहे हो. इन ट्रांजिट नहीं है ना, आपने लोड कर दिया, यू आर फ्री. आपने लोड कर दिया, यू आर फ्री आफ्टर दैट. FOB shipping. FOB shipping means the moment you load it, you're not responsible after that. आपने ship पे चढ़ा दिया, you're free. Then anything happens in transit, it is not your problem. Is that okay? That means whose inventory is that? It is the seller's inventory, buyer's inventory. Buyer's. Point clear है? Any doubt here? So for FOB shipping, it is in transit. When I talk about in transit, it is the buyer's inventory. Can I say that? Is that okay? Yes, no? Clear, Anita? Second is FOB destination. FOB destination. That means you are not free after loading the material, you will ensure that it reaches the port. It reaches the port of the buyer. So for in transit, who would be responsible? For in transit, who would be responsible for FOB? Seller would be responsible. That's what I'm saying. In transit, whose inventory is that going to be? FOB destination. Seller's inventory. Point clear? Both the points are clear. Demo. Okay. Let's try one question here. Taxpayer has sent to a consignment agent. Taxpayer has sent consignment agent $10,000 on consignment. Whose inventory is that? Taxpayer or consignment? Taxpayer's inventory. Another person, let's say A. A is sending to taxpayer goods on consignment. That means here who is taxpayer? Taxpayer is a consignment agent in that case. Let's say the person has sold the material for $5,000, sent the material for $5,000. Whose inventory is this $5,000? Taxpayer or A? A. Because अब यहाँ पे आप एजेंट की तरह एक्ट कर रहे हो ना बता। अब यहाँ दूसरे बंदे ने आपको कंसाइनमेंट पे माल बेचा है तो आप एजेंट हो। अगर आप एजेंट हो, इट इज नॉट योर इन्वेंटरी ना। Is this clear? It's the reverse of what we have done it earlier. Okay, so this is not going to be your inventory. This is going to be your inventory. I hope it is okay. Point clear. If generally, if you're doing any business, let's say you are doing the business of selling the shoes. You're doing the business of selling the shoes. Then if for your office, you are purchasing stationery, you are purchasing cartridge for the printer, you are purchasing A4 sheet for printing, is this inventory? Would you consider that as inventory? No. This is consumables. This is not your inventory. If you are doing the business of shoes, then shoes is your inventory. This is your consumable. This is your expenditure. This is not inventory. Point clear what I'm saying? Yes, no. Any question today? Do you have any doubt? Let me know. I'll repeat this. Anything not clear? Previously, whatever we have done it. Previously, whatever we have done it is not clear. No? No, nothing. So I think Namita, it's better that you please be involved in the class because I'll not get to know that how much you are able to understand, how much you're not able to understand. So I think after this conversation, I think you are getting better with it. I hope so. Please involve. Otherwise, I will not get to know because I was assuming that you are getting all the things. But it's better you ask. Okay. Perfect. I'll stop it here only today. I'll see you guys tomorrow. Bye bye. Good night.